Hello, everyone, and welcome to Tandem's Ask the Managers webinar. We're glad to have you with us today. As you know, I'm Angus Shaw, Senior Managing Director of Tandem. I'm joined by Amy Bush, Chief Investment Officer, and Tom Gerbeth, CFP, Director of Client Services. We also have Robbie Cohen, Senior Advisory Associate, helping us in the background. Your cameras will be off throughout today's session, and you are currently muted. However, once Amy is done speaking, you'll be able to ask her any questions you have. Tom will coordinate the Q&A session with Robbie. Before we get started, I'd like to go over a few items so you all know how to participate today. You may have joined the presentation listening using your computer speaker system by default. If you would prefer to join over the telephone, you can select phone call in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit text questions by typing them into the questions box of your control panel. You may send in your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end. For anyone who wishes to ask their questions live during the Q&A session, you will have a hand-raising button on your control panel to let us know you wish to be unmuted to ask your question. I would now like to introduce Amy Bush, Chief Investment Officer.
All right. Well, thank you, Angus, and thank you, everyone, for being here this morning or this afternoon. I'm going to get right into it. My objective today is to try and explain what's happening in the economy, what we think is going to happen going forward, and how that shapes your portfolio going forward. So what we have here, this is called our hope graphic. Right now, what we've been experiencing since last November, the Federal Reserve, Jerome Powell, came out and said we are going to be very aggressive in increasing interest rates because it's the only way that we have to squash inflation. How did we get such white hot inflation? Well, we had too much stimulus to get us out of the pandemic. The Fed, which they now admit is an error, they waited a little bit too long to raise interest rates. And in the process, that combined with all the fiscal stimulus that we had to combat the pandemic, it created an inflation situation that we haven't seen since the late 80s. So most of us are having to plan for inflation in our budgets for the first time really in decades. We see the Fed getting aggressive to do that and having to raise interest rates even further from here to do that. And so we just wanted to explain how that filters through the economy, and this graph helps us do that. So if you think about time, starting here with the earliest and moving from left to right in time, these are the four big categories of the economy that are affected. They're affected in this order, and it works both when we're increasing interest rates and when we're decreasing interest rates. So right now we're increasing interest rates. The first thing to slow down is going to be housing. So Angus and Tom and Chuck and I, when we meet on a weekly basis in our investment committee, which is part of our process, our weekly process is meeting, and we discuss all these macroeconomic variables. And you can see on the top here, we've listed some of them, and they relate to each one of these four categories. We look at over 100 different economic variables, but when push comes to shove, we probably really focus on about a dozen or so. And a lot of them are called leading indicators, and they tell us what's going to happen on down the road. But these are just some of the variables that we look at in what we call top-down macroeconomic analysis. That's the first part of our process. Once we know what's happening there, then we know where we are in the business cycle. There's 5 stages in the business cycle. We're in the 4th one right now. We're coming down into the part of the business cycle where we really slow down. Once we know where we are in the business cycle, then we know what to do in your portfolios. Then we know which one of the 11 economic sectors that we should either emphasize or de-emphasize. So that's kind of the top-down view of the process. Macroeconomic trend analysis, then where we are in the business cycle, and then that tells us what sectors to emphasize in your portfolios. For the past 6 months, we've been making the portfolios more defensive. What I mean by more defensive, we've been adding the sectors that are less sensitive to changes in GDP or gross domestic product. So those sectors include healthcare, it includes consumer staples, and it includes utilities. So things that no matter what else is going on in the economy, that things that we kind of have to buy. So an example of a staple would be like toothpaste. Utilities, you're probably always going to pay your utilities. Healthcare, if you break your leg, you're probably not going to put that up. So those are the sectors that we're turning to now. And because we've seen housing slow, for example, up here, this NAHB index, that is what's called a housing sentiment indicator, and that is falling. That means housing, the construction industry is starting to get really pessimistic. Another indicator that is affecting us, or it could be affecting you in your budget, especially if you're looking for a home, 30-year mortgage went from 2.5% to near almost 5.5% in less than 6 months. So if you're looking for a house, that's a big change that you have to plan for in your budget. I read a story in the Wall Street Journal recently about some young couples that were in the process of building their new homes. They did not have interest rate locked in, and now they're looking at a huge payment that is going to make them forced to adjust, the other parts of their budget. So other things get affected. But housing is the first thing to go, and we've seen that already deteriorate. Next up are orders. And these are manufacturer new orders. And we've been watching, the statistic we watch for this is right here. It's called ISM new orders. There's tons of different ISM indices, but what they tell us, no matter what one you're looking at, we like new orders because that's very predictive. It's called a leading indicator. Anytime it goes below 50, that means the economy is contracting. That means corporate earnings are probably contracting. The ISM New Order Index, it has been above 50 for 2 years, but it started to slow about a year ago, still growing, but we've been slowing for about a year. But for the very first time in 2 years since the beginning of the pandemic, our new order number went to 49 this last month. So it just went below into contraction territory. We are likely, we're in the third quarter now, we will likely show a negative GDP number for the third quarter. That's what this number has told us. Okay, so the economy is probably in this part right here. We are moving into next week, we're going to start earnings season where companies report their second quarter results. And then the most important thing is they're going to tell us what they expect for the next quarter. And that's really what Angus and I and Tom and Chuck are listening to there. We're going to listen to what they think is down the road. And so that goes to profits. Right now, we looked at a graph of profits for the S&P 500. You would see that they are close to 16%. That is an all-time high, 16%. Where they started, just to give you an idea of the progression of the profitability of these companies, back in 1990, the average profit margin was 10%. After the great financial crisis, it rose as high as 14%. And that's really where we've kind of leveled out. 14% is about the mean. But after the pandemic, because there was so much stimulus, and I think if you read one of our last commentaries, we said that companies during the pandemic, the big got bigger. And they also got way more profitable. So what we think is going to happen is companies are going to come off that 16% operating margin. They're going to revert to mean. So a more normal operating environment. So probably around 14%. They might not go quite that low. Why? Because of technology, because of improvements in technology and productivity. Over time, companies within the S&P 500, they become more valuable. Obviously, if you have a more profitable business, then the overall value of the market can rise. And so that's why companies become more valuable over time. So that's the next to go. That's what we are looking for. And we'll see it in the forecasts for profits for the next quarter. And we expect to have more what we call negative earnings revisions for the next quarter. That means that we expect CEOs and chief investment officers on their quarterly conference calls to tell us that next quarter is probably not going to be as good as next quarter. Okay, so that is the P of hope. And then finally, employment or jobs. Jobs are the last thing that falls in an economic slowdown because Jobs it's the biggest expense for most corporations, usually between 60 and 70%. So the only way to protect your profit margin, which protects your stock price, is to cut employees. That's the easiest and the quickest way to maintain a profit margin. So right now, we are as tight as we can be in the labor market. Unemployment is what the Fed calls full employment. There are over 11 million jobs still available. So that is what you should consider a very, very tight labor market. So we think that is coming down the road. So what does that mean for the economy? We're really, the Fed has increased, like I said, increased interest rates 1.5%. They are on their way to what they think is 3%. And that's what they consider neutral. Now that's short-term interest rates. Long-term interest rates, for example, the 10-year Treasury rate, what you see on the Treasuries now, around 3%, that's been controlled by investors. And that's a function of future growth and future inflation expectations, and when we've kind of leveled out there. So going forward, what does that mean for our portfolios? It means we're going to continue to get defensive. So we've been doing that for about 6 months, and you're probably going to see it again next week. We're going to probably layer in a little more defensiveness before earnings start. You might see that in the form of added utilities in the portfolio. That tends to be the least economically sensitive of the 11 sectors and can provide us more safety in the portfolio. So while stocks have adjusted down a great deal already, that adjustment was because of the changing backdrop of higher interest rates. So we think that stocks have a little more room to fall here to account for what we see as falling earnings. Remember, reverting to the mean, going from that 16% operating margin back down to around a 14%, more normalizing the economy. The Fed is trying to squash inflation. And why this has been so different compared to last recession, what is different? It's because the Fed waited a little bit too long. They admitted they made a mistake. They waited a little bit too long. So now they're increasing interest rates into a slowing economy. And so that has hurt both fixed income, that has hurt both equity returns. We think that in terms of the fixed income returns, we have a little bit better second half on the horizon. A majority of the work has been done in terms of tightening financial conditions. That's what the Fed is trying to do. They're trying to slow me down, you down, and corporations down from taking out more credit. It's the only tool that we have for getting inflation down, and inflation is it's a new phenomenon for this economy. So with that good news, I just want to say this doesn't feel great now, this part of the cycle, but it's a necessary component. This is just how the economy works. We work in cycles. Fortunately, these downturns last a lot shorter in duration than our expansions. Our last expansion lasted almost 12 years. But we do want to, prepare you. We think the economy has more work to do to wring out the excesses that were brought in by all this fiscal stimulus. And so again, what that means for our portfolios, you're going to see us making them more defensive. The next thing you'll probably see from us, we're going to probably add some more utilities into the portfolio, and that helps us on the downside. So with that in mind, I'll try and end it on one positive note here, and that's one of my favorite sayings. And it goes something like this: the best investments that you usually make, they're in downturns. You just don't know it yet. You won't know it probably for 2 years. So that goes to what we all need to have at this time in the market. It's to show some patience, to know that we're going to stay balanced, we're going to stay diversified, and we're going to continually rebalance towards your long-term objectives. The important thing is that we stay invested and stay patient while this part of the market works out. And this is a time when Angus and Chuck and Tom and I are working the hardest to make sure that we go down less. So I'll stop talking on that note. And Tom, I'm going to pass it off to you.
Thank you for that, Amy. And we're now going to begin answering the questions submitted during today's presentation. I'll go ahead and turn it over to Robbie to address any questions that have been brought up so far.
Perfect. I'm not seeing any questions just yet, so Maybe give them another minute.
How about if I ask a question of Amy? Amy,
Yes.
do you see this? I mean, again, we can't predict anything, and this has certainly been a period of time when predictions have gone awry. But do you feel that this may be more of a garden variety recession, such as those we had in the 80s, or do you feel that this is different?
So let me throw out a statistic to try and answer that, Angus. On average, a downturn in the market like we've so far experienced, on average, it takes 2.7 years to recover from that type of downturn. So that kind of gives you a little bit of from a normal downturn. There's nothing about what has happened here to make me believe that, this is going to be any different than, I don't want to see 08 or 09, but let me explain it more like this. The hope graphic that we just looked at takes about 12 to 24 months for rates to filter through the system. So Angus, I would say that we probably have another good 6 months of economic data showing deterioration, and then we can probably start looking forward from there. So, like I said, 2.7 years is the average time that it kind of takes to recover from the degree of downturn we have. But also remember this: data does not come to us in a straight line. It's jaggy, kind of like this. But what we're going to do to determine that, Angus, is we're going to keep looking at these leading indicators to tell us when the economy is improving. So we're going to look at things like the initial jobless claims. When those stop going up, we know we're close. We're going to look at credit spreads, when the amount that you have to pay for credit, when that stops widening, that'll tell us we're near the end. When those PMI new orders, when those start going down, that will tell us that we're getting near the end. And then we can switch from those sectors, from the healthcare, from the staples, from the utilities. Then we can start to move the portfolio back into the more economically sensitive things. But we're going to keep an eye on our economic leading indicators. We go to our process. Every single time when we don't know what to do, we go to our process. Our process starts with those macroeconomic leading indicators, and that tells us what to do. We are not guessing. We have a process, and it starts with following the data. The data does not lie. There's no opinion in data. There's no, talking heads manipulating the data. The data does not tell lies. So that's what we watch. It's time tested. As the saying goes, history doesn't repeat, but it sure does rhyme. And the same indicators over and over again will tell us what to do.
I think that it's really important what you just said, Amy, and the ISM Manufacturing Index, which is known as the Purchasing Managers Index. It's a monthly indicator of U.S. economic activity. That's just starting to show recessionary signs right now. We're right at the edge there. So many of the leading indicators still look decent, but they're coming down quickly. So.
Yeah. I think one of the most common retorts you will hear on television, for the reason that we can't be in a recession, it's because labor is so strong. Well, that's just because it's the last thing to fall, right? It's the E in our hope. It's the last, so it's really strong now. But trust me, it's going to start to fall after profits fall, because it's the big lever that corporations can change to maintain profitability.
Right. And Amy, could you speak a bit to price earnings multiples and how those really have not changed dramatically, because we haven't seen the profits come down yet, correct? So stocks are still, just maybe talk about valuation of stocks real brief.
Sure. So valuation, the most common measure we have is called the PE ratio, and that's price divided by earnings. And right now, if you take all the companies together in the S&P 500, and you take the price of the S&P 500 divided by all the earnings, you get a multiple of about 16.6 times, which is consistent with the long-term average. But we have one problem with that, saying that the market is cheap, is because the only thing that has adjusted in that ratio is the price. The price came down to adjust again for the higher cost of credit behind us, but what has not adjusted is the E. Consensus sell side, so from Wall Street analysts, they publish all their consensus guidelines for the S&P 500, and what they're currently publishing is 9% growth for 2023 off of 9% growth in 2022. Now, I mean, just think about that intuitively. If interest rates were 0% and now they're going, for 3%, how could companies possibly earn the same next year as they're going to earn this year? It's impossible. So we know that that E has to come down. There's no one that's really going to avoid the higher cost of credit. The point of the Fed's tightening cycle is they want to slow down the housing market. They want to slow down the stock market so that you don't think that you're wealthy, so that you don't take out more credit and spend more, so that inflation doesn't go even higher. While I'm on inflation, I just wanted to mention one other point. The Fed has taken a lot of grief for being behind the curve, and they should, because they made a mistake. They admitted they made a mistake, reacted too late to increase interest rates, to try and get control of inflation. The problem with inflation, although it's starting to roll over a bit, we do see some areas where we think it will remain elevated. As in energy, because of supply and demand imbalances, because we underinvested. The housing market, while 6% interest rates are going to slow down affordability, the housing market, we're still undersupplied, and that's because we stopped building in 2008. So we're still have a problem with housing. We're still going to have a problem with energy. The Fed can't really do anything about energy. The Fed cannot really do anything about our supply chain that we found out during the pandemic, that we can't make everything in China. We do have to make some stuff in this country, and that takes time. We found out that we cannot get all our semiconductors from China, because when we can't build cars, automobile production is well off its average. So there's some things that are going to keep inflation elevated. We are seeing commodities starting to roll off a little bit, but we do think that inflation is going to settle at a higher level than it did in the last expansion. The way that it was measured, or the way that it's measured, even though we believe it's kind of underestimated, averaged about 1.8% in the last expansion. We believe it's going to settle much higher than that now. So even though it's starting to subside, that doesn't mean we're going to roll back to last expansion's prices. We're going to settle at a higher level. And so we think that has implications for everybody here today. I know I'm, planning my budget a little differently for next year. And so we wanted you to also think about that, because we think that inflation is going to probably the next year settle 3 to 5% higher, whereas it was at 2% before. It takes a while. As this graph shows you, it takes like almost from 12 to 24 months for higher rates to filter through the system. So I'll stop talking.
Well, and I think that what's also important, I know we have some questions too, so I'll just say this, that was really good. But I think that what's important here is that, no recession looks the same. This is very different. And hopefully, like I said before, we're getting back to more of a garden variety situation, as opposed to 2008 to 2010. I think that people, that was really a very significant event due to the financial crisis and mortgages written that should not have been written globally.
That was tougher because the backbone of the financial system was really under threat. I think that's what made that so difficult.
Right. So I just think it's really important to keep that in mind. And this is going to be long, but at some point, equities are still the best and only kind of shield for inflation. and that it's out there. And what likely is not going to happen, since the Fed is kind of taking us through this storm and trying to unwind a lot of this monetary policy that was too much in this, and too much for the system. But as they unwind that, things are going to be different than last time. Does that make sense? Or
Yeah, and I would also add, because the Fed realizes now that they did too much, because our legislators realize now that they probably gave too much fiscal stimulus, that sets the bar higher for the next time around. They will be less likely to decrease interest rates faster. Our legislators will be less likely to provide fiscal stimulus when the time comes. So there's a saying in economics that the seeds of the next expansion are planted in the current recession, and the seeds of the next recession are planted in the next recession are planted in the next expansion. So in other words, everything is connected. Everything is connected in life, in nature, and for sure in investments too. So we will time. That's a long way off, but what the Fed does now affects what happens in the future. And I'll say one of the reasons that the Fed stayed dovish or let interest rates stay at zero for so long is because of what happened in 2008. If you go back and look at the labor market after 2008, it took us 7 years to reclaim all the jobs that we lost in 2008. And I think that's really, and I think Jerome Powell actually said it. He said, in the last recession, we came too late, we did too little, and we left too early. And that clearly affected what happened this time.
that's really a very good point. Okay, Robbie, do we have some questions?
We sure do. Our first question comes in the form of a raised hand here. I am unmuting the attendee that raised their hand.
Hello, can you hear me?
Yes.
Hi, this is Nick and Shabera. Angus, how you doing? So very good presentation. I'm very educational. But questions are what we're seeing now about the E, and I think Amy kind of talked a little bit about it. That the E still needs to bottom out, and just seeing some reports about the labor market that they're still high. They added more jobs this last quarter than the previous quarter. So there's kind of like three questions. Sorry to hog the time there, but so on the bottom part, it looks like on a downward trend. So Amy said that it takes about 2.5-ish years for this to run its cycle. How deep and must we always go through the E part? And then once we kind of bottom out and are on our way back up, what are the indicators to kind of tell us that we are on our way back up? Is the same ones that tell us that we're on the way down? And then my third question, just because I was just dreaming of retiring soon, and it kind of looks like a little bit further away. I do hear stories about the bull market and the bear market, people able to continue to make profits in a bear market, and I don't know if those are items that are available to me in my 401k for my company that you're running for me. But if you could talk a little bit about that also.
Okay, so the last one first, the bull market versus the bear market. Yes, you can make money. In fact, if you go back and look at the returns of 2009, 2010, 2011, those were all positive years following 2008. So yes, we can still make money when we're in a recession. If you kind of think, investment markets are forward looking. And so what we're experiencing now is some of it is accounting for what's going to happen in the future. We just think that there's more downside ahead. So again, forward looking. And yes, we can still make money even coming out of a recession. So that's part of your question, I think. I think you asked about labor and how deep it can go. You know, we don't know the exact number, but like you said, we are gonna keep looking at our leading indicators to tell us when that happens. So let me talk about our favorite leading indicators, and you can also keep track at home if you would like. So the biggest leading indicator is what the Fed says they're going to do, and what they're saying they're going to do right now is they're going to be aggressively increasing interest rates until they see inflation come down. So until they say they are going to stop, that is going to hurt the stock market. Okay, so that's one thing. That's one leading indicator. The other leading indicator we can look at are initial claims. And again, this is, you can Google jobless initial claims, and it'll take you to a website, and you can track that. And what we have seen is a subtle uptick in initial claims. So don't be fooled by what they're saying on TV. Employment is going to drop. It cannot not drop if costs are going up. It just part of the cycle. It just has to happen. We just don't know how deep it's going to get, but some of those leading indicators are going to tell us. Another leading indicator that you can watch is the price of the S&P 500. That is telling you what is going to happen going forward, and it's still going down. What we have seen are 4 bear market rallies so far. There have been 4 distinct rallies in the current downtrend that we're going to have. We just believe that we have further degradation. It's not a great story that I want to tell, but we're being completely honest because we're following the data. And we're following those PMIs too. There's a bunch of different PMIs that you can follow. If you Google ISM PMI services, ISM PMI manufacturers, those are the 2 big indices that you can watch. Think of those as leading indicators for earnings and the economy. So when if you see those slow, you know that we're on the upturn.
I'm sorry, I didn't mean to interrupt, but I also think it's important that none of those indicators also show us when we're starting to enter into a recovery. They start to change as well. So we have nothing right now that is showing us that we're headed towards a recovery yet, but we'll get there. And I think the other thing that's really important, and this touches on something that Amy just said, is you know, sometimes people call up when things happen like this at NIC. You know, folks are getting closer to retirement and they get concerned, and they say, hey, maybe we should cash out, maybe we should sit on the sidelines. The issue is that Amy just said, you know, we've had 4 bear market rallies in this. And so the days when you're coming out of something like this, if you miss, you know, several of the days when the market starts to recover, several of those rallies, the return differential is significant.
That's right. So remember, data does not move in a straight line. We cannot pick the bottom. I wish that we could. There's some traders that you'll see out there on NBC, but they move in and out of cash. I would be surprised if they could do that consistently well for 40 years, 50 years. And that's what we have to do. They can't.
You're right.
But we do know that if you stay invested in the market over time, it will recover and you will recover. Importantly, you do not need your entire fortune in 1 year. You do have time for it to recover, even if you're withdrawing from your retirement account on a regular basis. You're not retired. You are not taking it all out. You are leaving most of it, and it is going to recover as time goes on. Like I said, 2.7 years is the average. I don't know if it's going to be longer than that or less than that. But every single day, we're watching the data, and that gives us a clue of when that's going to happen. And as soon as that data reacts, then we react.
Right. And I also, that's a good point for those of you on the call or the webinar today that are currently in retirement and withdrawing money on a monthly or quarterly or annual basis. You know, we adjust our trading based on that, and we monitor, you know, on days that we, you know, that look more opportunistic to trade, and days that don't, we don't. And so we're being very, very careful right now. And I do think that we were kind of quiet in the beginning of all this. I think that's my fault. I apologize. We weren't communicating as enough to people, but we were very, very busy working on analyzing the data. And I would say the street overall and most economists got things wrong. And we were quiet, trying to absorb and process before we got in touch and started communicating more clearly.
I'll just throw a few numbers out there in terms of what the consensus for next year in terms of GDP consensus. Economists still think that the economy is going to grow over 1%. The economists that we follow at Piper Sandler and Company, she's been following the market for over 50 years now. She has she has GDP down 1% for next year. So she does not forecast a severe recession, but definitely she's ahead of the street in thinking that next year is a full-blown down year for GDP.
And Amy was a bit cheeky in the beginning, and she said that we stole the graph from Piper Sandler. But just so you all know, we have a relationship with Piper Sandler, and they are our outside economic research firm out of New York City. And Amy, how many? The team there is probably about 50 people.
So they were formerly known as Cornerstone Research, and last fall they were acquired by Piper Sandler. So the team from Cornerstone leads, but now they have. I've noticed the economic team it's really big now. So they added resources with this, but the people that we originally prescribed to, they're leading the team. So, but it's definitely, I've noticed they've been sending me more research, so we're getting more bang for our buck.
And Amy and I have had an experience of working with what is now Piper Sandler, formerly Cornerstone, since the 90s at our old shop, Victory Capital Management.
That's right. Nancy Lazar is the name of their chief economist, and I remember in my first days at Key and Victory in the early 90s, she would come to the office. So she's been at it a long time, and so has their equity strategist too. Have done a really nice job and provide all sorts of data and support for us, which is great.
And they also provide, for instance, during the election cycles, they have an ongoing political team too that does political analysis. So they really cover a lot of bases. And with that, I think if I'm not mistaken, Tom and Robbie, we have a question on politics and coming elections in the market.
Correct. Yeah, the question was, how will the election affect the economy?
It will probably, I would say less gets done around election cycles. Fewer decisions are made in terms of legislation. We don't expect there to be any fiscal stimulus on the horizon. Certainly not. Too much of that has already been doled out. I would note one thing that I do think happened with Jerome Powell. I think that he was up for reappointment by Biden, and usually what happened when that's on the horizon, Fed chairmen usually aren't increasing interest rates. My take is that the interest rates would probably have started 8 months prior if that hadn't had to happen. So that's one thing that, even though the Fed is supposed to be non-political, they do work with the administration. So that's one thing. But in terms of the election, what happens is that we just have less cooperation because no one wants to change anything. So that's on the horizon.
And as far as the market goes, I'm sorry to interrupt. As far as the market goes, often if there's uncertainty in politics or the election or the administration or where things are going, the market will often trade sideways for a period of time.
That's the part I forgot. Thank you, Angus.
That's okay.
Yeah. Gridlock. Our system was designed for gridlock, our political system. Sometimes I think too much. I don't know. We'll see. Yeah, but and usually I would say that we don't make investment decisions based on who's who's in office. We just have to deal with the fallout. That's all we do. Whatever any decisions that are made that have economic implications, we just deal with our politicians lay in our lap. So I guess that's how I think about politics.
And just a follow-up question, what does trade sideways mean?
Oh, that means that we don't go up and we don't go down. The S&P price just stays the same, so zero return.
Perfect. You all have touched on this somewhat already, but I will ask it. How would you compare this to the downturn in 2008?
Yeah, I think the bad part about 2008 was that the backbone of the financial system was under attack. The banking system was not strong. Banking system, the banking system just overlent, basically. That recession was an excess of over lending, mostly on the mortgage side. The other difference between now and then is that the consumer was in pretty bad shape. Leading into the 08, we overspent. Just all consumers overspent. And so post financial crisis, the savings rate of the consumer was elevated. It averaged about 7% up until we got to the pandemic. Then we got tons of stimulus, and it's starting to go down now. What concerns me now heading into this recession is that the consumer was really strong for the last expansion, and now that savings rate is down to about 5%. So that's concerning to me. That's below about an average of 7% pre-pandemic. And we've also seen credit pop up. And when credit goes up at the same time the consumer confidence is going down, which is happening, it's really not good. That means people are taking out credit because they have to, probably, and not because they want to. So the difference between this one and the 08 is that in 08, the banking system was not strong and the consumer was stronger. And now the banking system is very strong and the consumer is starting to weaken out a little bit, which concerns me. So those are the big difference. The important thing is that the banking system is in good shape, and that's because they took such a beating after 08. We're really, because consumption is 66% or so of GDP, that is why we have decreased consumer discretionaries in our portfolio, because we're so much pull through of spending during the pandemic. We think that we probably pull through 2 to 3 years of good spending during the pandemic. And so that's going to be weak going forward. But again, the important thing is the banking system is strong. Corporate balance sheets are really pretty strong. That's how they got to 16% operating margins. And let's see, anything else? Anything else? In terms of the housing market, I would just say that the housing market, I don't think that we'll have a disaster there because supply is so limited. Angus, anything else?
Well, I think that part of our process, there's the quantitative part, and then there's also the qualitative part. And there is for each of you as well at home, our clients, our investor clients. We are working on managing the quantitative part of your portfolios and your investments, and then the qualitative are your goals and your objectives, which are so important to the overall investment. But I also wanted to note that there's kind of a funny thing that happened this week. Amy and I have been having a big debate about Target. And, we actually go out to, if we own a store or own a company like Target or Costco, et cetera, I mean, we're going to these stores and we're comparing notes and taking a look and see what's going on in management and what's missing on shelves and who's doing a better job. So we spend a lot of time working on this, and that's really what we've been doing since January. And as many of you know, I took a sabbatical this year, but when the market started to get a bit more choppy, I came back and was working more closely with Amy. But I am now back in the office full time. But we're out and we're looking at things and we're talking and we're having conversations every day, all day. And I think I'll wrap up with this and say that the before 2022, so the 3 years prior, we had an average annualized return of the S&P 500 of 26%. Was it 26%,
Yeah.
Amy and Tom? Okay. 26 average annualized return for 3 years on the S&P 500. That made me more uncomfortable than where we are now. What is going on now is understandable. There's still a possibility of an unknown risk. I think that the Ukraine war, even though it was known, I mean, I think certainly you saw troops and mobilization happening since last fall, but it really turned into a bit of an unknown risk because I don't think anyone really called right the disruption that it would cause, even though we were very familiar, that Russia supplies Europe and is the main supplier of gas and oil. But I think that this is, when I say this is headed towards kind of a longer garden variety recession, we think there's many things here that are unfolding that are understandable and quantifiable. And so what we try to discuss on a daily basis are those unknown risks that could enter in and cause more disruption. And I'll turn it over. I've been talking too much. I wasn't even going to talk. I apologize.
So
Any more questions?
No, we don't have any other questions or any other hands that are raised.
All right. Well,
Okay.
with that, I just wanted to thank everyone for attending today's webinar, and just let you know that if you do have any other questions that come up, please feel free to contact either Robbie or myself. If you're still feeling a little uncertain about things during these more volatile time periods, now is a great time to also check out and revisit your financial model. Or if you haven't put together a financial model yet, we can help with that process as well. So on behalf of Tandem and our presenters, thank you for joining us today and have a great rest of your day.